Most of fair value gaps that you identify are false. The problem is that the common definition of a fair value gap, 3 candles and a gap in the middle, is not enough. If you are not looking at the context behind the gap, you are not treating a fair value gap. You are likely treating a trap. In this video, I will show you the exact strategy to confirm whether a fair value gap is valid or invalid. Take notes and let's get started. First, let's quickly start with the definition of a fair value gap. A fair value gap represents a zone on a price chart where a significant and rapid price rise or fall occurred. No trading or very low trading occurred within that zone. For that reason, such a zone will indicate the market inefficiency. Fair value gap leaves behind unfilled orders. Price will eventually return to fill or rebalance this gap, providing trading opportunities for retail traders. To confirm a fair value gap, traders typically use the following models. A mainstream method to identify a bullish fair value gap is based on this 3-candle model. The middle candle is a strong bullish candlestick. The wicks of the first candle and the third one do not overlap. The area from the high of the first candle to the low of the third candle will be a bullish fair value gap. Learn smart money concepts trading with my book. Get the essential SMC trading basics and the complete trading strategy. For more info, check the link in the description below. The book is also available on Amazon. A bearish fair value gap will be based on 3-candle model with a strong bearish candle in the middle, where the wicks of the first and the last candles do not overlap. The problem with these two models is that they are not accurate. A lot of regular, efficient price movements would fit in that category, and these models will simply mislead you, indicating a lot of wrong fair value gaps. The good news is that there is an efficient way to empower these models, making them way more precise. The one extra confirmation layer that I suggest using is multiple time frame analysis. Let me explain. To confirm a fair value gap, we need to make sure that a very little trading activity occurred within that, and that the price action within is inefficient. Lower time frame analysis will help us assess the trading activity within a potential fair value gap. According to common rules, this bearish fair value gap on a pound-dollar pair on an hourly time frame is completely valid. It is based on a 3-candle model with a strong bearish candle in the middle, and the wicks of the first and the third candles do not overlap. However, a 15 minutes time frame analysis shows that the market was efficient in that zone. The majority of the price levels within this fair value gap zone were traded both by the sellers and by the buyers. So this fair value gap is invalid, and the market never filled that. And what time frame to use for a validation of a fair value gap? I simply suggest using a time frame that is 4 times lower. For example, if you spotted a fair value gap on a 4-hour time frame, validate that on an hourly time frame. If you see a fair value gap on an hourly chart, check 15 minutes time frame then. And as an exception for a validation of a fair value gap on a daily time frame, use a 4-hour time frame. Now let's check this potential bullish fair value gap on a euro-pound pair on a 4-hour time frame. Let's see what happened inside the middle candle with lower time frame analysis. On an hourly time frame, we can see that the imbalance was left within that zone, and the price moved quickly within. We see a rapid price movement with a little trading activity within that area. So this fair value gap is valid, and the price successfully filled that. Now look at this potential bullish fair value gap on euro-dollar pair on an hourly time frame. From 3-candle model perspective, it looks like a perfect fair value gap with one-sided buying imbalance. However, 15 minutes time frame analysis reveals that the price moved up and down, filling almost single price level within that zone. The chart looks smooth and efficient. So this fair value gap is invalid. And as you can see, it wasn't filled. Look at this bearish fair value gap on a dollar-yen pair in a 4-hour time frame. From a 3-candle model perspective, it is a valid fair value gap, but let's confirm that with lower time frame analysis. The hourly time frame analysis confirms inefficiency and aggressive selling. Most of the price levels within that zone were not traded by the buyers. So this bearish fair value gap is valid, and you can see that the market successfully filled that. Checking what happens within a potential fair value gap is the key. It provides the edge in understanding the behavior of the market participants. This simple method will help you expose fake fair value gaps and identify the most powerful ones, avoiding traps and manipulations. Let me know what you in the comment section if you have any questions. Learn smart money concepts trading with my book. For more info, check the link in the description below. Also, please watch my other videos.